And take your attention over here. This old low and these relative equal highs. Old low, below that is sell stops, and relative equal highs above that is buy stops. Now you could have used this high here. There's nothing inherently wrong about that, but whenever I see equal highs like this, and if it's higher than an old high over here, I'm going to use that. The sell side liquidity, you can see that the market trades down, hits that, runs through it, then rallies all the way back up, clearing the equal highs. So the buy stops have been taken here. Okay, so at both of these price points here and here, that's the point at which you'll look for or anticipate a market structure shift. And you don't force it. Okay, I see a lot of people try to teach my concepts. It'll talk about market structure breaks or shifts, and we'll use that term interchangeably. But for intraday, I want you to think about intraday market structure shifts, because it's not necessarily a break in market structure that leads to prolonged multi-day movement. Okay, what do I mean by that? If you see a market structure that's bearish and it's broken to the downside intraday, that may just lead to an intraday price leg that may eventually see that high be taken out in the same day. So that's why I'm using the term market structure shift, not market structure break. For our conversation here on this mentorship, just know that when I'm going to lean on that term, market structure break, it means a little bit more in context versus an intraday shift in market structure. It just means that there's likely a downside draw or an upside draw intraday by saying the term shift. Okay, so there's a little bit of semantics there. All right, so we have both of these areas here and here where there would be a likelihood of a market structure shift. Up here, we look for a fake run above here. So that fake run above, how do we know it's going to be a market structure shift that's bearish? I get that question a lot, even from mentorship students. What you're looking for is the evidence I'm going to show you here tonight, okay? Forget everything else everybody else says about market structure breaks and shifts and all that stuff. This is it, okay? This is the brass tacks. There's absolutely nothing else that you need to know about it. I promise you. If they add anything to it, it's just because they want to sound and look different. But this is the algorithmic perspective of a market structure shift intraday. Now, keep this price level in mind. So it's essentially 14,600 and 14,820. We're just eyeballing it, okay? Now, dropping all the way down into a 2-minute chart. This is that same particular day. Here's those relative equal highs and this run down here. If you look at this market structure, we have this high on this candle, then we have the candle right after that here, the highest one, and then the lower high of this candle here. So that's a swing high. Very simple little pattern, but it means a lot when it's in the proper context. When this high is broken with this particular candle right there, that is significant only on the basis that we have taken liquidity out of the marketplace. That's it. So when it broke this short-term high, this is more meaningful. And then the market will start to seek buy stops, okay, or buy side liquidity. That would rest above here, here, and here. Now, I shared an example of live executions, and I was teaching on the idea of utilizing micros, which are essentially $2 per handle, okay, so or 50 cents per tick. This chart is NASDAQ E-mini. This would represent $20 per handle. And there's 4 ticks in each handle. There's your $20 per handle. Okay, so again, what that means is 14,680 to 14,681. That's one handle or 4 ticks. So here's those sell stops. So this little area here it's shaded in, that's a area where sell stops would be residing below that 14,600 level, okay, on that 15-minute time frame. So the market dove into that liquidity, and you may or may not know that is a buy. You don't need to. You anticipate a shift in market structure. When the market rallies above, when does that happen? On this candle right here. See that little light bulb? That's when you're thinking, okay, now I have a condition in the marketplace that I might see an opportunity intraday. Let's see if there's further evidence to that. Short-term high is taken here. We traded above it. It does not need to close above that. Okay, real important. Once that candle closes and this candle opens, you're going to monitor this candle, and you want to see as soon as this candle closes, does it create that fair value gap? If it creates a fair value gap, again, that's a candle at the high, one single pass up. Next candle has a low that doesn't completely overlap all this. That's a fair value gap, real simple, okay? This candle is where you would look to potentially trade at the earliest, because now there's a gap there. The market trades down into that, boom, takes off. Here is insight that everybody needs to understand because they're out here running around on YouTube trying to teach order block theory. Order blocks, okay? I invented it. It's mine. No one talked about it before me, and I first mentioned it in 2010 on baby pips. Prior to that, 1996, I was only teaching it to people one-on-one in teachings. That's it, okay? You can't find it in books prior to that. It's mine. No one else taught it before me. It is mine. So I'm going to correct all of you today so that way you can teach your people correctly and not hurt them. See these down closed candles? See that? That's all one continuous order block. What's it doing? It's inside that pool of liquidity, sell stops. Where's the open on that series of down closed candles? Right here. That's the price level extending out in time. Boom. So inside this fair value gap, this opening price on the order block, that's your buy, plus 3 pips or whatever for spread. And that's what you would use for a limit order. Well, price starts to run where? Above the highs where buy stops would be here, above this high here, and above this high here. Now go back and look at the example where this particular day here, I put in orders and I was still learning how to use the Thinkorswim platform. And there's a little toggle box where if you toggle it, it'll send your order right to the marketplace. It won't let you review it. And I had put that on to see if it was going to show me any kind of information on the screen, but it didn't take it off. So what happened was I put that on, and it was actually an order that I mistakenly had in. So I was hoping to see if it could give me an opportunity to get out of it and cover with next to nothing, or maybe even squeak out a profit. It wasn't having it. So I had to reverse and then go back and go short, wrote it down, and then you'll see me covering in here and then going long, selling short, reversing, going short, buying long in here inside the order block, rallied up, sold the long, reversed it, bought it here, got out over here and resold for that big run into that, okay? That's what I was doing. There's people out there who are going to tell you, he doesn't trade that way. These people don't know how I'm trading. You have no idea how I'm trading. None of you do, okay? The buy stops above here that was taken, this swing low forms once this candle closes. So this candle we're watching, does it go below that short-term low? It does. So now we have a shift in market structure that is now bearish, only because we've taken buy stops, okay? Fair value gap forms. The market rallies up into that. You go short there. What are you looking for? Below here, sell stops. Below here, sell stops. Below here, sell stops. And in this fair value gap here. So if you are in a position that has multiple contracts, or say you have a Forex trade, because this works in Forex too. It's not just limited to futures. Again, I'm just using this asset class because I cut my teeth on these markets. When everybody else was still in elementary school that's trying to teach today, I was trading the S&P. I probably sound like a young guy, but I'm actually getting ready to turn 50. So I've been around for a long time, 30 years, this November 5th, 30 years. That's 3 decades. And the things I'm teaching you, I'm not teaching you one trick pony insight. These things work on all asset classes. Now, I'm not going to co-sign the crypto markets because that only my students are reporting that this stuff works there. I don't even mess around with it that much to know, okay? But you can take partials below here. I really wouldn't do it there, but below here, here, and I know some of you are saying, well, why wouldn't you take them below their ICT? Well, if you're trying to get short here, that's not really that much movement. So if you're going to take something off your trade below that low, why not just try to reach for that one? And you could get it there, right here, okay? And then below that low is nice as well. Below this low, and this is what I mentioned on the first lesson, okay, elements to a trade setup. This is below the 50 level of this high and that low, Okay, so 50% level, that's what we're targeting. Now, this candle's low was the high end or first objective inside this gap. So that's your target. You're going to look for that. So you're looking for low-hanging fruit, the easiest target to get to. You're not trying to be perfect. And you grow into eventually holding to see if it will fill in that gap. Okay, this fair value gap. In other words, going down to this candle's high. That's something that you strive for over time. If you understand what I just showed you here, that's a very simple process of looking for, number one, liquidity, gauging what happens without having to know for certain, because you don't know. You're not going to know until the market shows its hand. This is it showing its hand. Okay, that's it. Now, let's go into a 1 minute chart and see how that looks a little bit different, but still has the same characteristics. Here's that same price structure, just on a 1 minute chart. The same logic's still there, right? Swing high taken after liquidity's been traded into. This short-term high gets violated. Right when this trades down in here, what's actually occurring? Okay, put this in your notes. High frequency algorithms are hammering. They're just throwing orders in, buy. That is not, okay, here's the important thing. That is not causing, okay? It's not causing the market to go higher. It's just volume that's coming in. The algorithms that deliver price, that offer price, that are constantly offering the price in the marketplace, that's what's beginning to spool and go higher, okay? And regardless of where you want to trade at, your limit orders, they may not get filled. Where you're trying to buy with a market order, you may think you're getting in at 14,662, but by the time your order is executed and confirmed, you're in 14,664. That's slippage, okay? That's negative slippage. If you were trying to buy it at 14,662 and it filled you at 14,661, that's positive slippage. That's better than what you were expecting. So when the price starts to rally, all this is a default to the algorithm constantly offering price at a higher price. Okay, and the logic and argument for anyone that wants to say, oh, it's buying selling pressure, this guy has no idea what he's talking about. I know somebody that used to trade on the floor and he's laughing at ICT right now. Okay, go into your charts. Forget that. I'll let you have that perspective for a moment for the argument, but go into the charts and see if what I'm not suggesting to you is the truth. Okay, I could sit here and do a complete series on all the things that lead to what I'm saying is true, but none of you will still believe it. I'm showing a live account and entries and executions, and they're still doubting it. So no matter what I do, there's going to be people out there, but you didn't do it wearing orange. You didn't do it in your Corvette that you flip, which I don't flip Corvettes. You're getting all kinds of stuff out there. Nonsense. Look in here. Okay. For the guys that say I did not take trades or I didn't trade this way. You see that gap right there? See that? See that down closed candle right there? That's your order block. Boom. Buy it right there. What about this? Right here. Dropping down. All these candles here are more significant if you look at it on a 2 minute chart. See that? It becomes one order block. Right in here. Buy it, sell short, buy it again. We got up into the stops, sell short, reverse, then ride the larger swing down. Don't listen to these yahoos out there that say that I'm not proving something to you. I'm proving it. That's what I said I was going to come out here this year and do. That's this whole point of being here this year. It's my 30th anniversary, November 5th. I've been a trader in the markets, living and breathing this stuff for 30 years. So the 1 minute chart, just a real nice delivery here as well, filling in that fair value gap, changing the state of delivery. Now it's offering sell side. What's that mean? It's going to match up sell stops. It's going to keep going below old lows and into an imbalance until we get down to a discount. Is that hard? Is it hard to see what I'm showing you here? Pretty clean, isn't it? Clean chart. Now, I don't have all these things on my chart when I'm watching price because I already know what I'm looking for. And I don't want to have any distractions, and I don't want to have a level or some kind of annotation that's going to keep me thinking only with that perspective, okay, or that idea. It allows me to be fluid with what the market's actually doing versus going in and saying, okay, this is what I think is going to happen, and this is the only thing that can happen. You understand what I just did there? I allow myself to be flexible, whereas if you have all these things you're putting on your chart, you're only seeing your will be done. So I keep my charts clean. And then I add the annotations so that way my students can see what the internal dialogue in my mind was while watching price do what it does naked. There's nothing on the charts at all when I'm trading. Zero. Nothing. Okay? So with that, I want you to think about how this is useful. Okay? Number one, you're looking at London highs and lows, the session for London open. Okay, for instance, like 2 o'clock in the morning to 5 o'clock in the morning. New York time. Every time I tell you, just always set it with New York local time. 2 o'clock to 5 o'clock in the morning. That's your London session. What's the highs and lows of that session? Okay, that's important because the market's going to probably sweep above those highs or sweep below those lows and create situations like this. Okay, and the New York session is 7 o'clock in the morning to 10 o'clock in the morning, New York local time. Okay, what's the session high and low for that? And do the same thing for Asia. Okay, 7 p.m. to 9 p.m. And that's it. Those are the 3 times of the day that I'm looking for specific key highs and key lows. And any intraday high and low forming right before the equities open at 9:30. Pretty easy, right? The hours of operation, again, are generally between 8:30 in the morning to 11, but it can be extended all the way to New York lunch, noon. I do not tend to take trades after noon local time New York. That hour is usually very problematic, and it's better not to even look for any kind of setups. Wait until 1 o'clock, preferably really 1:30 to 4 o'clock, then you get the afternoon trend. Typically, you'll see between 2 o'clock and 3 o'clock, there's a setup that usually forms in the afternoon trend or setup in that period of the time of the day that will also offer opportunities, but that's outside the scope of what I'm going to be teaching in this mentorship. But there's lots of things you can look on YouTube about the afternoon session, and you can just combine some of the things that I'm going to teach you here. And just, it's not hard to make an addition to what you're learning here. So that way, if you want to trade the afternoon session, you can obviously pick up some insights from other YouTubers that do trade futures. But for developing students, this is enough. I promise you this is enough, okay?